one of the interesting topic that I do a lot in Asia Pacific, whether it's in Korea, Hong Kong, China, Singapore, Malaysia, it is this topic, US market structure. This is the basis of understanding how the US market works. The first is really trading hours, as simple as trading hours. I'm sure a lot of y'all know about trading US, you can trade 16 hours a day, right? From 4 a.m. Eastern time, which is 4 p.m. our time, right? To 8 p.m. Eastern time, which is 4 a.m. Bangkok time, right? Total 16 hours. And I understand Webull platform even provide longer than 16 hours. But for the regulated trading hours, this is the trading hours, right? 16 hours. Now, what's so special about these 3 trading hours? Pre-open, regular, and after hours. And how is it different from the local market? In US market, there is already matching happening during the pre-open. And it is a good 5.5 hours. So the moment you enter an order or trade into, say, Webull platform, it will be executed. Unlike the local market or APAC exchanges market, where pre-open is just to send orders into the trading system. But in US, you put a limit order, it will be matched. Okay, so that's one difference in terms. So market already start from 4 a.m. Eastern time. All right, so mostly a lot of retail investors like yourself put in a limit order, or you just want to put a market order and then fill and then go to sleep, right? But if you put a limit order, pre-open, it will start matching continuously all the way to 8 p.m. Then you'll say, hey, Mr. Bo, then if it's like that, why have a difference between pre-market, regular, and post-market? It is the main focus on the data that you see when broker publish on that platform. The official data will be on regular trading hours. I repeat, when you see the opening price on the platform, it is for only during regular trading hours. Meaning, the first Tesla trade that happens at, say, for example, 4 a.m., that's not the official opening price. Okay, you will see whatever price, but that's not the official opening price that day. So you don't see, oh, Tesla opened $100, and then at the end of the day, you see something else. Then you say, hey, no, the opening price 4 a.m. is this. No, it is at 9:30. The official opening price of the US market is at 9:30, even though trading starts at 4 a.m. Okay, so that's one of the difference of US market structure, right? So the second, same thing apply for closing price, right? So you don't wake up next day in the morning and you look at the closing price, but you know, you look at 8 p.m. or you look at 4 p.m. is different. The official closing price is at 4 p.m. Eastern time. So all these statistics or static data that appear on the platform are based on regular trading hours. Okay? So understanding the trading hours and what data you see is also very important, right? I'll explain more. This slide will come out again. I will not go into this opening cross and closing cross because that's the highlight of today. Sharing with you what is opening cross and what are closing crosses, essentially the auction period, which is also very important, which is also very different from APAC exchanges, right? This is where we understand the next very important about US market structure, and that will correlate to market data that you see on the platform. In US, in US, there is, and I'll share why this will happen. In US, there are 17 exchanges. Unlike APAC exchanges, there's only one exchange locally, whether it's Singapore, Malaysia, Hong Kong, or even Thailand. So because there are 17 exchanges, and the next slide will share with you why, this happens. There is such thing called the on-exchange and off-exchange trades. And to that lady that mentioned about, is it OTC? It is not. In US, there's such thing called the on-exchange and off-exchange. Why is that so? On and off, right? And it's about, you see, 50-50%. So what are on-exchange trades? Very simple. On-exchange trades are orders sent to the system, whether it's Nasdaq, NYSE, CBOE, that got matched on the system. You are able to see the price and it got matched. That's on-exchange. Very simple. Like all exchanges globally. But what is off-exchange in the US? Off-exchange are trades matched outside the system. Paired, or like cross-trade, matched outside, reported back into the system. Okay, and how they report back? Through this thing called TRF, right? Trade Reporting Facility. So in US, there are 3 TRF, 2 operated by Nasdaq and 1 operated by New York Stock Exchange. So for example, a broker, client A send a Tesla order to buy. Client B send a Tesla order to sell. And it matched perfectly in terms of shares and price. The broker can cross the trade without sending this A order or B order to the exchange. It can match and report this match trade via TRF. So the match trade via TRF only see the traded price, real-time traded price, no codes. The codes is within the broker. Okay, sorry. Am I speaking too fast? You understand about the difference between on and off? On is normal exchange, order sent to exchange, broker, client A sent through broker A to exchange, client B sent to exchange, the order to exchange, exchange match, on exchange. 40.9%. The 50.4% off exchange. So you could see that in terms of data, the off exchange data is also important because sometimes depending on the stock, the price movement can be determined either by the on exchange or the off exchange. Right? Some, there's no off exchange activity, it's all driven by on exchange. Right? Clients sending orders to the exchange or the broker sending the orders to exchange and get matched. But there are some tickers that are really strong in the off exchange trade. Okay? So that's the second differences in most compared to most Asia exchanges. There's such thing called the off exchange. This is not OTC. All these are the correct volume that is reflected as the overall US trading volume for that day. Okay, this slide is also important. This is the top 10 traded securities by US retail investor, updated till the 3rd quarter this year, right? 4th quarter haven't finished. There are 3 information you see here. One information is of the 9 top traded, of the 10 top traded, 9 are listed on Nasdaq. Of the 10 top traded by US retail investor, 9 are listed on Nasdaq. So that's the first information, right? So very clear, right? The Nvidia, the Tesla, these are all retail investor traded. Just to share with you this data. The second, there are a lot of ETF are also being traded by retail investors. Just to share with you so that in your investment journey, you know what are the so-called, your peers in the US are trading, right? And this so-called ETF are the leverage and inverse ETF. 3 times bull or 3 times bear, leveraged. Right? So this is the second. There's only one company, one listed company that is not listed on Nasdaq. So for the Magnificent 7, over 70% of the trade volume appears on Nasdaq. So I'm going layer by layer on leading to market data. So that you understand the structure, you understand all these flows and traded companies and where it appears in the data. Yeah, sorry.
If the more clients trade on Nasdaq exchange, does Nasdaq got get revenue?
Okay, good question. If there are more and more trades happen on exchange, that's between the exchange and the broker, of course. But what's the spin-off of having more data on Nasdaq trading engine, right? It is the market data, which is where my business sits and where our partners like Webull will enjoy so-called leverage on this quality data. Because Webull's platform is able to see more action or more blinks, updates onto their market data, whether it's level 1 or Nasdaq TotalView level 2. So in terms of revenue, it is the byproduct like market data. No, also volume, right, between the exchange and the broker. For example, between Nasdaq and the broker, there will be, why will some broker want to put orders or trades onto Nasdaq? So that will be some bilateral arrangement, for example. On exchange, yes.